Welcome back, everyone. Given everything that seems to be going on in the markets, I figured it was a good time for me to give some added details that I think don't get as much attention as they probably should. So the market right now is extremely bifurcated. There are some people walking around with giant heads and feeling great, and other people that are probably closer to curled up into little balls. And it's weird that they're both going on at the same time. And this has led to a lot of stories and a lot of people saying things that are mostly true, but I feel lack some balance. And so that's what I was going to try and add, because definitely some of this stuff you'll have heard, but some might be a bit of a different perspective as well. So I want to start with growth stocks. There was a whole segment of the market for a while that was essentially growth at any price. And so while I'm sure that the thing you've heard is that growth stocks are selling off because of interest rate hikes, yeah, but if you look at a number of the growth stocks that have been absolutely beaten down, it's more than that. It wasn't just, oh, the interest rates are going up, everyone panic and reduce the multiples of the market. It was, no, growth is slowing. Is this stock actually broken? Because there's a few that were very high growth that all of a sudden the growth looks like it's stopped and now the stock is down a lot. So this isn't just interest rates. And I think that's one element that's been kind of under-discussed, because the market is very good at doing math. If you see a 20% growth rate, people can look at that and maybe plug in an 18 or 15% in their discounted cash flow models, and because they're conservative, and they'll come up with a price that the stock should be worth, because look at last year and then look at this year, the earnings are up 20% or whatever, or look at even call it 2 or 3 year growth rate. But the thing is, what happens sometimes is that it goes from growing 20% to it has a bad year or accelerated growth. So maybe it was 10%, then 30%, and then 20%, and then, oh wait, hang on, the growth is slowing. And so the market kind of looks at these straight lines, and all of a sudden the thing that was supposed to be worth $20 in 5 years at this growth rate is only worth 10 in 5 years at a slower growth rate. And so then you get the market repricing things lower based on the floor of what the market believes a company will fundamentally be worth. The floor falls out, and all of a sudden what you thought was growing at a high pace was not, and it hurts. But with that story, along with the interest rates, you have things like crypto and other things really that have essentially been acting like unprofitable tech, because in many ways they are. And as much as it feels like some other things shouldn't be, you could argue, and I wouldn't fight you too much, that uranium has been kind of caught up in the same type of story. Why? Well, this kind of move has spread to various forms of risk off. But the good thing about this market is that it has made some distinctions, because the market has moods, and sometimes it just wants to give things that could be worth a lot more all of the money that they want to try and get there. Other times it doesn't want to give anything any money. So when companies are caught up in the wrong time, or when things are caught up in the wrong time, and then the mood changes, well, that's risk. And aside from perhaps on Friday, some of the things that are real companies growing real earnings at reasonable prices haven't really been caught up too much in this wave of volatility. Now, while the stock market isn't the economy, what I do think is happening, what I do think happened really, is that we saw the surge of stimulus into a broken, shut down economy. And so you had a lot of the primary beneficiaries were some of these tech pandemic names that got all the growth rate because money was kind of forced in that direction, and then that kind of slowing or coming off really, and they had the highest valuation, so they were the canary in the coal mine, if you will. But then now hits the inflation, now hits the everything, and now so the narrative is there's inflation. There's so much inflation. Haven't you seen all the inflation? And what does that mean? That means the Fed's going to hike, but they're not just going to hike. They're going to hike more, and then that's not enough because there's still inflation. They haven't hiked yet, but they're going to hike more. So there's more hikes, and that's still not going to be enough because there's going to be more hikes, and that's kind of where the market is right now. So on one side you have this slowing growth, on the other side you have, oh my god, this inflation that's endless and forever, and on the other side you have, oh, but the Fed's not doing anything about it, but they're about to, and that's going to hurt. And on the subject of the Fed and inflation and oh my god, how behind the curve are they, I'm feeling like a crazy person because it seems to me like some people out there might not be understanding how year-over-year data works. And look, I get it. I see the 7% inflation, and that's a lot. In normal times, that's absolutely a concerning amount of inflation. However, there are clearly broken supply chains, and they're probably not going to last forever. There is the stimulus effect in the economy. There's a lot of base effects that kind of people won't look at when energy's down 50% in a year, but when it's up 50%, oh my God, it's only 7% inflation. That should be 50% inflation. So there's stuff like that that's going on. And you look at how year-over-year data works, and I mean, one of the most likely calls in the market that I've seen in a long time is if you look at April, May, what's going to happen with year-over-year inflation data. I'm not going to tell you because A, I don't know what happens between now and then, but B, I would suggest looking at it and thinking, okay, unless we get some corresponding surge of inflation in the next few months, and by the way, the data is not pointing to that I've seen. It's pointing to slowing retail sales and wearing off, a declining savings rate. Nothing that I've seen is really pointing to accelerating inflation. But we could get it. I mean, of course, there's, you never know what happens with energy and whatever. But into the second quarter of this year, year-over-year data will have an incredibly difficult time of keeping up with anything near the inflation rate that we last saw. And what does that mean for the Fed? It means, look, they haven't even said that necessarily that they're going to hike in March. By the way, they're still easing, and we're pricing in 5 hikes. That's insane to me. But if we keep, let's say they hike in March, I'm going to roll my eyes an incredible amount over the next few months after that, because what I think happened is I think inflation falls. And then I think, people start talking or pricing out hikes or whatever. And then there's like, oh, is the Fed pivoting? Is the Fed pivoting because the market is trouble? No. The inflation will look like it's declining, but people will say what they want to say, and it's definitely going to fit the narrative of whatever they want to complain about. But my point is that if the Fed pivots, look, I can make an argument that they should pivot now, but I don't think they will because of all this pressure. And look, don't get me wrong, I do see still some inflationary pressures, but I also see some things that are more in the direction of recession than of out of control inflation, because at a certain point, inflation, it hurts demand. People can't afford to pay an infinite amount for everything, because that's kind of the direction that things have been going. Now look, we're a few days away from the Fed speaking, and I think a lot of this sell-off started because of fear of the Fed, fear of hiking, or just pricing in hikes. We have increased hike expectations significantly in this calendar year. But I do think that the sell-off has moved a bit beyond that, and look, we have this catalyst in a few days that everyone is concerned about the same thing. Now, I'm kind of inclined to think that we start to have a rally first, and I also think that probably whatever they say, they could say, oh yeah, we're going to hike 4 times this year, or yeah, we're going to hike starting in March, and we are going to cut QE to 0 and start, I don't think that's more bearish than what the market is kind of concerned about right now. So basically, I think the risk of whatever they say is to the upside. I think that whatever the reaction to whatever scary thing that they say or don't, it's going to be considered dovish, and probably the market rallies off of it. Now, that obviously depends what happens first, but that's kind of what I'm thinking. Now, when it comes to commodities, the metals, well, the base metals, I guess I could say, is getting a bit messy, and I'll lump steel in with that, because you look towards China and they're easing, and then you look towards North America and they're looking towards tightening to perhaps excessive tightening into perhaps even arguably slowing demand growth. So that's messy. They've been stronger than I would have thought. I also, look, I've been leaning in this direction for a while and wrong, but I kind of thinking, well, maybe not that wrong, but I'm thinking we're approaching more of a time for gold rather than some of the base metals. So that's kind of where I'm thinking we go, along the lines again of a bit more defensive, not go to cash or short everything, but just kind of position more, defensive. Now, I've seen a few people comment or ask about housing and cars and point to different conditions in both markets, especially in North America. And look, so there's a few factors at play here. One is seasonal periods, but even if you factor that in, one could say that conditions are not great in both markets. And on one hand, yes, that is true in terms of the prices are not conducive to a lot of buying. On the other hand, and this is the one thing that I think is missing from those conversations, is that that's because demand has been too strong and we are out of inventory. We are out of inventory in houses. We're out of inventory in cars. How do I know that? Well, I mean, A, there's charts. B, you look at the price of used cars, the price of houses, and they are just going up and up and up because of demand. So if we are at a point where demand is weakening, it's probably because people have been started to be priced out of the market or have been exhausted. They want to buy a home, but the price has gone up, and they want to so they try and pay more, and the price goes up, and they're exhausted. But the demand and the supply is still, in my opinion, very favorable over the multi-year time horizon. Because on both, you look at cars, they're aging, and there's no inventory of new cars, there's no inventory of used cars. Housing, North America, all of North America, short houses. And so I'm sure there's people that are saying, yes, but it's a bubble. The price is a bubble. And maybe in some places, sure, but there is more demand than supply, and that's what makes prices go up. And if that reaches bubble levels, that's possible. But those are two big sectors that haven't been receiving enough supply, and there's been supply chains problems in both of them. And now I know I'll get some pushback here, but I don't think that means is necessarily inflationary, because there's a lot of other components that go in, and there's a lot of expectations, and everything, there's more expectations than what it would be a one-to-one correlation or what you'd think. Now, when it comes to stocks versus markets, it's a bit of a different question, because what matters more so in the long term is valuations and growth rates, and can the company continue to make more money in the future or not? And so from that perspective, there's still a wide range of situations out there. Some stocks are still, in my opinion, extremely expensive, but there's others that are probably going to offer you good to above market returns purchasing here. And finding out which is up for each individual to kind of place their bets. Now, what is important to figure this out is, what are the stocks expecting? Are they stocks expecting too much relative to what will happen, or too little? And if you understand both what they're expecting, and you have an idea and can guess at approximately what the next few years will look like, you'll be fine. If you're right, that is. Now look, some to many of my stocks have been hit by shifting expectations, shifting interest rate repricing, and so some have gone down, and for the most part, my targets haven't really changed that much, because I don't. Even if the interest rates go up, I don't think that 0 to 1 to 1.5% is a huge deal in most of the positions, but it is lower expectations. So just as long as you have a target in mind and understand how sometimes things will change a little bit, and maybe the price goes down because the market completely changed its mind and something's broken. Maybe it's just repricing for a better opportunity. It's not always one versus the other. And the other point that's important to be made is that, there's some people that will point out, well, look, the market is only 10% off the highs, approximately. Depends if you're talking S&P, NASDAQ, which country. I mean, Canada is only like 5% off the highs. So why is that only a little bit off the highs, and yet you have some things that are down 50+%? Well, because really, the market, when people talk about the market, they're talking about maybe 10 stocks, because that's what constitutes a market. You have FANG and you have big tech. Most of them are big tech, or approximately that. And so when we're looking at big tech is what you really kind of need to do to make a market call, that plus fund flows. And when I look at it, again, we have, some of them, I think Google, Facebook, Constellation in Canada, you could probably buy today and you'll probably make money over the next few years. Then you have the Microsoft, Apple, and Amazon, and you have those type of things where the comps to me seem questionable enough that I don't really know if they're dangerous or fine, good buys. So I don't know one versus the other. And then you have some other things that they concern me. The Tesla, Netflix, well, not Netflix, I was thinking of Nvidia really, and Shopify in Canada. Whereas those, if the growth slows, they're in a lot of trouble. Now, some could argue for some of them it might be when the growth slows, but the market, again, is very good at looking in a straight line. So if you have these things that look like they're growing very quickly and are going to reach some great target in a number of years, then they can keep going up, even if the price is whatever it is, because in the future, it will be worth more. If they stop, you could wake up down a few $100 a share and it could be broken. And so that's, I'm not saying it will be, I'm just saying if it breaks, your reality has changed. And so for that reason, the market, and when people say, oh, which way is the market going, or market calls or stuff, yeah, look, the market reference is either like a headwind or a tailwind or a fund flow or, what you might want to look at for beta or whatever. But in reality, the market is very few stocks, and that isn't really representative of the random stock. And so it's not necessarily how it's going for all people. And I'm a believer that if you find very good stocks, if you find companies that will execute and are at reasonable to cheap prices, they can go up in almost any market. And we've seen some of that too. That said, while I'm on the subject of spewing useless commentary, I will do something that might approach making a market call. So we started to see volatility spike. And so the volatility spike normally, is mostly in line with the dumping selling. We've seen also some correlation approaching one. I wouldn't say correlation one. I wouldn't say it's dump everything, but that's normally later game selling. Now it could last a while for sure, but we've seen the VIX spiking and it's approaching 30 on a bit of a parabolic type of move. So, if we get 1 or 2 more days of that, I would be thinking that this spike downwards at least is over. So I wouldn't say we're definitely over now, but if we open lower on Monday or worse, we have a bit of a rally Monday and fade into Tuesday, I would think that would be the point for a rally at least, because I think we're overdue for that type of thing. Now, would I necessarily say buy the thing that has been absolutely killed and hold it for the next 5 years? No, I wouldn't necessarily say that either. But could it go up a number of percent in short order because things got way oversold? Sure. And in conclusion, the thing that really is key to understanding the market is it's not in terms of reality, it's not in terms of today's fundamentals, it's not in terms of if this company can grow earnings, it will go up that much. That's not how it works. The market works in terms of growth expectations, inflation expectations, rate expectations. And, you know, different little nuances. Are people fearful? Is there a lot of money flowing? All of these things, expectations that you can't really completely calculate. You won't know. There's no one that's going to tell you, well, the market is expecting exactly this, this, and that. You can't know them, but every price in the market is based on a set of expectations. And, you know, if you're exposed to high expectations and things do better than that, well, you could still make a ton of money. And, you know, if you have limited expectations and the company completely sucks, you can still lose money a lot. So expectations are risk and are what the market is pricing in. So as long as you're not undercut by whatever reality undershoots expectations, probably do fine. But it's important to realize that everything out there is based on a reality that the market believes is the current reality. And things will change. So you can't win them all. Hopefully you can win some, and hopefully the wins are bigger than the losses. And that's really how I focus on it, and that's really most of what I wanted to say today. So with that, I wish everyone a great day, and until next time, good luck in the markets.